Yo guys, what's up? Eclipse here. Just a quick video explaining my Shopify trade today. The one that ran 200%. I want to show you guys why I took the trade, what was the reasoning behind it, and how you can use the strategy that I actually implemented into this trade. You can use it on other trades because this was a specific strategy that I used to do the trade. So let's get into it, guys. So as you can see, Shopify had a major gap up here, and that was because of the earnings, right? So first of all, this strategy is called the IV flush, and IV stands for implied volatility, if you don't know. All right. So Shopify opened at $53.88, right? The original was $47.97. So that's almost like what? $6 move up. That's pretty crazy overnight, right? So we can see here 47 or 48 to 54 almost, okay? So when a stock gaps up like that on earnings, there's something called IV that you guys got to understand about all earnings plays, all of them, right? IV is implied volatility. Before the earnings, everyone doesn't know what's going to happen, right? No one has no idea if it's going to go up, if it's going to go down, if it's going to stay flat, if it's going to stay the same. No one knows, so there's a lot of anticipation. So if you guys look at any options contract, you're going to see the implied volatility percentage. And I guarantee you, if you look at any stock before the earnings, the IV is going to be through the roof, like at least over 100%, 200% sometimes, 300, 400 sometimes, right? Depends. So why does it happen? Like I said, no one knows what's going to happen, so the anticipation goes up, so the IV goes up, right? That makes the contracts expensive more than what they're supposed to be, okay? After earnings, what happens? The anticipated move is revealed. So IV actually goes down, the percentage, which causes some contracts to lose value even though the stock went up. For example, Apple earnings tomorrow. As you guys know, we grabbed the 170 calls. If Apple opens at 168, those 170 calls are still going to be red. Even though Apple went from 165 to 168, yes, it did go up, but those 170 calls will be red if it does not open above or at 170 tomorrow. Why is that? I've explained it to you. It's because implied volatility. If it's not in the money on earnings, the IV goes from being super up to getting crushed. So it's been revealed what's going to happen. So if you're not on the dot, you'll lose money. So how can you use this to your advantage? It's pretty simple, guys. After the earnings, usually it happens after market or pre-market the next day. There's going to be times where you'll see the stock has gone up, but the calls will be down. Like, for example, say I saw Roku the other day. If you guys look at the Roku chart, Roku opened up flat. That caused all the calls to be down 90% at the open. And I saw contracts go from 10 cents to like 70. That's like 600%. And that happened in 10 minutes, right? So I actually used this on Shopify today, right? I used this on Shopify. We opened up here. I saw the previous daily resistance right here. I use daily chart always, guys, to mark the levels because it's going to be the most big levels, right? I don't like going on the 5-minute and marking 50 different levels. I like when you have a few levels that are strong and that I know will actually work, okay? That's another thing. That's another topic, okay? But just wanted to tell you guys real quick. So I saw we opened up here. I was waiting for us to break the previous high, which is 54.67, right? But in my head, I'll round it up to 55. So once I saw we were holding above 55, and you can see here volume was starting to pick up a lot, I went long. Why? I bought the calls, the 59 calls, because they were so cheap compared to the other calls. If you look at the open, the calls that were in the money, right, in the money were like super, like 1,000% positive, right? They were like up 800 or something, 800%. But the ones that were out the money, a few dollars, like 59, they were only up like 50%, 80%, or something like that, or maybe 100. I'm not sure. So if you compare that, yes, it's not always going to be negative like the Roku, like here. It's not always going to be negative. But if you compare the price, the earnings caused the out the money contracts to get crushed. It's not always going to get red. So you can use that to your advantage and buy the cheap contracts because of earnings. So there's a saying that one man's garbage or trash is another man's treasure. And that's exactly what's happening here. I bet you guys have had these times. It's not necessarily earnings, where you buy something for a swing and it opens red and it's like worth like almost zero, right? And you just want to sell it, get whatever you can out of it, and just sell it and get out. But you look 2 hours later and that shit's up like 500%, right? Because no one wants to buy it. So that's what's happening here, right? We opened up, broke resistance. I went long because the calls out the money were down compared to the ones that were in the money. So I went long on shop, right? You can use this on any earnings plays, guys. It's the IV flush. So let's go here to this page, guys. This is where I see the earnings. Let's see which ones are tomorrow. I have a few on my radar that I'm gonna be looking at open. I think Coinbase is gonna be amazing, guys, and it's even better because it's a Friday. So Friday, you know everything is like expiring the same day. You don't have to trade the same day expiration, but it makes the contracts cheaper, so it's even more powerful. So we have Coinbase. I don't know why they did this. They lied to us, guys. This was pre-market and they put it after close, so I don't know. So we have Apple. I'm gonna be looking tomorrow at Square, Apple, Coinbase, and DKNG. These 4 stocks. If they open flat or red or green, I don't care. The contracts out the money are going to be cheap. And if the stock starts going, you can take advantage of that trash or the cheap contracts. And if it goes your way, it's going to be more potential gains like we saw today for Shop for 200%. Right? So I hope that I could explain the strategy well enough so you guys can understand. It's basically playing the after earnings move. Right? The contracts out the money are going to be cheap. You can get them for cheap and make a shit ton of money, a shit ton of high percentages off just literally the stock doesn't even have to move a lot for that to happen, right? So you're buying trash and turning it into treasure just because the IV got crushed, right? So you're taking advantage of that, okay? So tomorrow, Coinbase can go crazy. Apple, crazy. SQ, DKNG, all of those, right? They can go 200%, 300% right off the bat. All right. So I hope I did explain it, guys. Very good. Like I said, it's not always going to be red. For example, today's Shop, they didn't open red. They opened slightly less positive than in the money. And that's always opportunity when you have this, all right? So if you guys have any questions about the strategy, feel free to private message me or ask me in any of the chats, tag me, and I'll make sure to respond whenever I can. But yeah, this strategy has made me a shit ton of money over the years, right? Because it's always like that, guys. When no one wants to buy something, it's always gonna go. Most of the time, it always goes crazy, right? But when everyone is chasing a specific move, it's most likely not gonna go the way of the majority of the market traders, the retail traders, right? So that's another thing to keep in mind. If everything is going to buy something, everyone is going to buy something, it's not always a good idea. But if you see good setups that no one else is paying attention to, there's always opportunity there. All right. Hope you guys enjoyed this video. Make sure to subscribe, like. I'm releasing a vlog as well. It's going to be insane, guys. That vlog is going to be absolutely insane. So make sure to subscribe. And yeah, I'll see you guys tomorrow. Let me know if you have any questions on the strategy. IV flush.